Hello, I'm Kristyn Amato, a senior accountant here at Withum, in our Founders and Tech Executives group. Today I will be discussing the basic qualifications and eligibility requirements for qualified small business stock. Qualified small business stock, also known as QSBS, is one of the most advantageous provisions in the tax code. It refers to stock that's issued by a qualified small business that meets specific criteria as outlined in Section 1202 of the Internal Revenue Code. Taxpayers who hold QSBS for more than 5 years may be able to exclude up to 100% from their gross income of any capital gains recognized on the sale. In order for the stock to become qualified small business stock, there are certain requirements that must apply to the company and to the shareholders who are selling the stock. The Section 1202 company requirements are generally as follows. Number 1, the company must be a domestic C corporation when it issued the qualified small business stock, and when the shareholder sells the qualified small business stock. The company cannot be an S corporation, a mutual fund, a REIT, or certain other specified entities. Number 2, the company must be engaged in one or more qualified trades or businesses during substantially all, which is generally between 70 and 90% of the taxpayer's holding period in the stock. The company must use at least 80% of its value of its assets in the active conduct of a qualified trade or business. They must not hold more than 10% of the value of its assets in portfolio stock, which is generally 50% or less owned subsidiaries, or real estate not used in the business. A qualified trade or business is any trade or business except for those specifically listed under Section 1202(e)(3). Number 3, the company's gross assets when it issues the qualified small business stock and immediately after cannot be more than $50 million. Number 4, the company must not have engaged in certain redemption transactions. Number 5, the company must agree to submit certain information to the IRS and to its shareholders. The Section 1202 shareholder requirements are generally as follows. Number 1, the shareholder must be an individual, trust, estate, partnership, S corporation, mutual fund, or common trust fund. Number 2, the shareholder must have acquired the stock directly from the company after August 10, 1993, in what we call an original issuance. This means from the company itself in exchange for money, property, other than stock, or services, but not from another shareholder in a cross purchase. There are exceptions that allow for reorganizations, gifts, and bequests of stock. Number 3, the shareholder must hold the stock continuously for more than 5 years without engaging in certain transactions that may hedge or minimize the risk of owning the stock. If all requirements are met, the shareholder's exclusion may be limited to 50%, 75%, or 100%, depending on the date of original issuance. Section 1202 rules are complex, but Withum offers a great team of professionals ready to assist you with all your QSBS eligibility questions and determinations.